Hello and welcome to this new episode of our Tax Update series. I'm Andy Rainford, your host. I'm a Chartered Tax Advisor and Content Editor here at Indicator. In this episode, under General News, we will look at two newly published investment zone tax site maps. Under HMRC News, we will cover how to help clients avoid late payment penalties and HMRCs, or warnings about scams connected with anti-money laundering supervision. Finally, under Cases, we will look at a resident's case that turned on whether there had been a distinct break with the UK, and a VAT penalty case where the tribunal accepted that ignorance of the law amounted to a reasonable excuse. Turning first to General News, maps of two new investment zone tax sites have now been published. These relate to Glasgow City and the northeast of Scotland. The maps show the precise boundaries within which various investment zone tax reliefs are available. These reliefs include, in particular, national insurance contribution breaks and enhanced capital allowances. The key point for advisors is that entitlement to these reliefs is highly location-specific. You'll need to check whether a client's activities or planned investments actually fall within the shaded areas on the published maps. For more detail, you can follow the short link shown on the slide, which takes you to the official mapping and supporting information. HMRC has confirmed that over 300,000 tax returns missed the 31st of January filing deadline for the 2024-25 year. Those late filers are now subject to the automatic £100 late filing penalty. If you have clients who still haven't filed, the key message is to get the return in as soon as possible. After 3 months, daily penalties of £10 per day can start to accrue, so the costs escalate quickly the longer the delay continues. On the payment side, there is no immediate late payment penalty on February 1st. However, late payment penalties begin to run from the end of February if the liability remains unpaid at that point. If a client cannot pay in full, it's important to agree a time to pay arrangement in advance. Doing so can mitigate or avoid some penalties, but it does not stop interest. Interest runs from the original due date, so clients need to be aware that there will still be a cost to late payment even where an instalment plan is in place. There has also been a warning about an increase in scams relating to anti-money laundering supervision. Fraudsters are contacting agents and firms asking them to update or reconfirm their AML supervision registration details. The advice is to be extremely cautious about any unexpected communication of this sort. Always verify the source and, where in doubt, contact HMRC using a trusted number or the official online services, rather than using details provided in the message. HMRC has reminded agents that it will only send emails from domains ending in gov.uk. Legitimate email addresses will look like those shown here. Anything that departs from that pattern should be treated with suspicion. Let's move on to the first of our cases. Mr. Kearney was a property developer based in Belfast. He moved to Gibraltar in March 2004 on professional advice, with the specific aim of becoming non-UK resident for at least 5 tax years in order to shelter substantial capital gains. However, in practice, his ties to the UK remained very strong. He kept the family home in Belfast, where his wife continued to live. He retained extensive UK business interests and directorships, and travelled frequently back to the UK. At the same time, he developed new leisure and business interests in Gibraltar and in Spain. In 2006, he sold his company for a substantial consideration, including both cash and loan notes. He then became heavily involved with the purchaser and with further UK property ventures, personally guaranteeing significant UK-connected borrowings. HMRC opened an inquiry and concluded that, despite the move to Gibraltar, he had in fact remained UK resident throughout the relevant years. They issued discovery assessments for capital gains tax, together with penalties on the basis that his self-assessment returns were negligent or careless. The tribunal had to apply common law residence principles, because the years in question preceded the statutory residence test. On those principles, the tribunal found that Mr. Kearney had never made the required distinct break from the UK. In other words, his lifestyle and connections were such that he remained UK resident for all of the years in dispute. The tribunal also held that the discovery was valid, and that the assessments reflected best judgment. The suggestion that the assessments were too speculative was rejected. Importantly for advisors, the tribunal found that Mr. Kearney was negligent or careless in relying on his original professional advice without seeking updated advice when his actual pattern of life diverged from the assumptions on which that advice had been based. The tax assessments themselves were therefore upheld in full. However, the tribunal did intervene on penalties, reducing them by setting a lower uniform percentage rate than HMRC had applied. And finally, Mr. and Mrs. Julian farmed on St. Martin's in the Isles of Scilly through a family partnership and were using the Agricultural Flat Rate Scheme, or AFRS. From the 1st of January 2021, new rules for the AFRS introduced a turnover threshold of £230,000. Where that threshold is exceeded, there is an obligation to notify HMRC and to register for VAT. In practice, the changes were poorly publicised. Neither the Julians nor their small firm, generalist accountant, who had taken reasonable steps to stay broadly informed, were aware of the new threshold. The partnership's supplies did in fact exceed the threshold. Once the accountant discovered the rule change in April 2023, the partnership acted promptly. They registered for VAT and paid over more than £500,000 in VAT arrears. HMRC nevertheless imposed a penalty for failure to notify liability to register. The amount came to just over £43,000, and the only point in dispute was whether the Julians had a reasonable excuse for not notifying on time. The tribunal considered the established authorities, including the Clean Car Company and PERA. Applying those principles to the facts, it held that, in this particular situation, ignorance of the law did amount to a reasonable excuse. Key to that conclusion were the poor publicity of the rule change and the fact that both the taxpayers and their advisor had behaved responsibly in trying to stay up to date. As a result, the appeal was allowed and the penalty was cancelled. The broader lesson is that while ignorance of the law is usually no defence, there are exceptional circumstances where a tribunal may accept it as a reasonable excuse, especially where the change was not well signposted and the taxpayer's overall behaviour was otherwise reasonable. Advisors should nonetheless ensure that clients in specialist schemes like AFRS are aware of threshold-based obligations and that systems are in place to monitor turnover proactively. So that's it for this update. The next one will be number 20. Now over to Millie for details of our next webinar. Bye for now.
Thanks, Andy. Yes, that's right. Our next webinar is on the final countdown for making tax digital for income tax. Andy and Rachel will be quizzing Robin Milstead from Accountants Therapy on getting ready for the April rollout. That's on the 26th of February at 1 p.m. and you can register using the link shown here.